Hello, everyone. My guest today is David Giannetto. He is the COO of a company called Astea International, leading sales, marketing, and service for the global leader in field service management mobility software industry. As an author of 3 books, a former columnist for U.S. Business Review and former EMBA professor, he's a well-recognized thought leader on how organizations utilize enterprise-level technology and methodologies to drive performance. David, you ready to take us to the top?
Yeah.
All right. It's nice to see a teacher get out of the classroom and into actual execution. So this is great. Tell us about the company. What's Astea do and how do you guys make money?
Astea is in the little talked about multi-billion-dollar field service management industry. So any company that puts technicians or workers out in the field to fix assets that are in place somewhere. Think of this building I'm sitting in. It's the building itself, fire, life, safety, all the computer equipment, air conditioning, heating. Every single thing around me or around whoever's watching this has to be maintained by somebody. And it gets more complex from there. It's think of your supermarket, all the refrigeration, all the chillers, the front end systems, all that has to be maintained. That's a multi-billion-dollar industry. And we make the software that connects that technician to customer service, to the warehouse and logistics, so that the right person with the right skills shows up at the right place, at the right time, and gives a really good customer experience.
And David, is your model a SaaS model as a piece of software?
It is mostly SaaS today. We still do on-premise. There are certain regions like Japan that still seem to prefer on-premise.
What's the percent breakdown over the last 12 months? If you look at total revenue, what percent was pure SaaS?
Well, of new customers, I would say 80-85% come into us new on SaaS. But the caliber of organizations we work with are large, global, complex. So it takes a number of years for them to convert over to SaaS.
Well, that's actually specifically why I asked the question that way. So not looking at new, but looking at your historical revenues as well. What percent is SaaS versus still on-prem?
Probably about 50-50 between maintenance and SaaS.
Okay, very good. And are you finding the number one kind of leading indicator on if you can get someone to go from on-prem to SaaS it is location?
Location, no. What we find is really, it's really just the culture of that organization. Have they gotten to a place yet where they're ready to outsource, put things in the cloud? Because it's a fundamental infrastructure change inside of that company.
But that's what I'm saying. Are you seeing Japanese clients that you have are less likely and less comfortable with cloud versus Canadian companies? Is it location? Is it really geography dependent?
We're at that regional level, yes. Yeah. Certainly US and Europe are well ahead of Japan.
Yeah. Interesting. Okay. And you mentioned working with kind of enterprise folks here. I'm sure you have loads of different cohorts you're analyzing. We don't have time to go down to all of them. On average, what are one of these customers going to pay you per year for access to your tech?
Well, they're going to probably pay per user per month. Okay. And that could, let's say that's $50 to $75 per user per month. And it could scale all the way up to thousands and thousands of users around the planet.
Yeah. Again, that's actually what I'm asking really is the average size of the account you're working with. Are we talking 1,000 seats usually or 10,000 or 1 million seats usually?
Sure. Yeah, we do break it up into 2 categories. So there's a group of clients that are about 2,000. And then there's a smaller group of clients that probably average in the neighborhood of 500.
Okay, interesting. So, I mean, we'll just assume kind of minimum here, right? So can I assume a 500 kind of person organization with these technicians or whatever going out in the field multiplied by that you call it $75 per month? That's like what, a 30 grand a month account for you guys?
Yeah.
Something like that?
You could do that, sure.
Okay. And just to be clear, that's $75 a month per kind of on-field rep they're managing with your software. That's monthly, not annually.
Well, right. It's going to be a range, but it is per user per month, rolls up to a 3-year contract for us.
I see. What's the cheapest someone can get that seat level down to if they do big volumes with you? Is like 20, 50, something?
Sure. You're going to drop maybe below 50 if you're thousands and thousands of users. Now, we do have an SMB technology that's a little bit different. Okay,
very good. And put this on a timeline for me. When did you guys launch the company?
Wow, this is actually Astea's 40th year in business.
40? Now, were you there from day one or you brought in more recently?
No, 40 years ago, I wasn't even out of school.
That's what I was about to say. There's no way.
Our CEO, our founder, is still with us. I've been with the company 3.5 years.
Okay, yeah, that would have been 1979 or 1980, right?
Yeah, 79. And we started the SaaS conversion, though, about 5 to 6 years ago.
Interesting. Okay, and how many customers have you scaled to today?
Well, there's probably over 700 licensed on the 2 products.
Yep. No, it makes a lot of sense. Now, if I even take the minimum you just gave me, the 700 times 500 accounts, right? Times 50 a pop there, so each company basically said could have 500 seats at $50 a pop. That's 25 grand a month times 700 accounts. I mean, you can do the math there. That puts you guys at like 17 million bucks a month. Is that right?
No. 700 customers licensed in the 40 years. So you'd have to go back and say what are active customers. And we also,
of course. I mean, over 40 years, you're counting someone that signed up in 1980 and then churned in 1980 as well.
Yeah, so we're going to have somewhere in the ballpark of, I would think, 400 active organizations.
I see. Okay, so even still, though, I'm trying to get a sense, generally speaking, I don't want to pin you down, but healthy company, right? 400 folks paying 25 grand a month. That's a $10 million a month business.
Oh, yeah. Obviously, we're not there. We're about, roughly speaking, a $29 million company.
Okay, fair enough.
We have two products as well. So we have the SMB product called FieldCentrics, and then we have our enterprise platform.
Yep. Okay. So 29 million bucks in ARR, that's about 2.4 million bucks a month. And if you have that across 400 customers, what is that per customer? Something like what, $6,000 a month?
Yeah, I haven't broken it down that way, but.
So you said two different product lines. Is one focused on the on-prem stuff and the other is SaaS, or these are two different things and they each have on-prem and SaaS components?
Well, they're both field service technologies, but so the breakdown in service, if you really understand service, is the complexity of the business. Do you follow multiple workflows or one workflow? And how many additional outside groups of functionality do you need besides the technician just going into the field? So our SMB product really can scale to thousands and thousands of users, but you're following a very simple workflow. Whereas the enterprise level, you have a lot of ability to use low-code toolkit to customize it. It's very nuanced. It's everything from full-blown customer service centers that are outsourced, project depot, warehouse management. It's an ERP level technology.
I see. And if you're at kind of a $29 million AR run rate today, obviously including that includes your on-prem, right? 1/3 of that is SaaS.
Yeah, that's total revenue.
Yeah. But sorry, you said earlier though, it's kind of 50-50 SaaS versus on-prem, right? So there's.
Sure. So there's three ways we earn revenue.
Yeah.
It would be license sales / maintenance. That's on-premise model.
Yep.
And you have SaaS per user per month, and then you have services.
Oh, I see. Okay. So of the 29 million in terms of last 12 months revenue, you're saying that those three lines are split about a third. 10 million in each.
Services is a little bit over a third.
Okay.
But yes, roughly.
Do you find, go ahead.
When companies like us, everyone from SAP down to us, we're still in that mode of counting recurrent revenue as a combination of maintenance and SaaS.
Yeah. Which, by the way, there's nothing wrong with that. The question I was going to ask you though, do you analyze stickiness of the accounts that have spent money with you on professional services, and how much more likely are you retain someone who also spends money with you to do services work for them?
Well, when an enterprise adopts our business, we run their business. We are the mission critical application they have. So the lifespan of retention is over 10 years for our customers. They stay with us a very long time. It's a very impactful event if they were to switch to a different technology.
Yep.
And there is a constant feed of services because the platform is really driving change in the organization.
Yep.
If it's our SMB, it's a different relationship. They get up and live, maybe 60 days. There's very little services after that. They're just in a pure multi-tenant SaaS model, and there's not a lot of services.
I see. Have you guys bootstrapped the company or raised?
Well, it's a long history.
Well, 40 years.
We've gone through the conversion of on-premise to SaaS, which is a tough conversion to make. Really just bootstrapped it. No real outside investment. We are active in the investment community now. So the CFO and I will do. When's now
the right moment?
Well, if you looked at the finance, we started turning a good corner. We reached that point of profitability, 3 years of double-digit growth. The stock price has performed really, really well. And it's at a point now where if you can get the stock price a little bit up, you can go out for a round of funding.
Are you guys public?
We are.
Oh, got it. So you would issue more shares, essentially, raise additional extra capital.
Right. And if your stock price is too low, it's too dilutive, and it's not really advantageous. So
where were you a year? You're at 30 million run rate today. Where were you a year ago?
Well, our growth is going to be roughly in the ballpark of 12%. We haven't released our actual earnings for 2018 yet. So
I see.
March.
Well, no. Well, take me back. So you're saying you were doing 29 million bucks in run rate back in January of 2018?
No. Well, we will close somewhere in the ballpark of 29 million.
Oh, I see.
Last year. If you look at through 3 quarters, right?
Yeah, you project.
Yeah, our fourth quarter is not released, but the 2 years or 2 or 3 years prior to that, it's double-digit growth, anywhere 11, 12%.
So that's what I'm asking, right? Is so the 12 months prior to January of last year, 2018. So this would have been most of 2017's revenue, right? Because it's January, February, March, April, all through 27. You're saying there you would have done something like 26 million, which then 10 to 12% growth would put you at 30 today.
Yeah, we're somewhere off the top of my head, I don't know, but we're somewhere close to 27.
Okay,
yeah.
Interesting. That's great. Okay, good. And then walk me through where most of the growth is coming from. Is it upselling or expand? Is it upselling current customers or adding new ones?
Well, to get us through this turnaround, it was mostly coming from the stability of the long-term clients we've had, getting them to a place where they could purchase more. So that's the first place we looked as we tried to get into a better position. That allowed us to make this conversion to SaaS and the accounting rules that impacts you with more easily. Once we started getting the existing customers in good shape, generating a pretty good amount of service revenue from that, we started focusing in on marketing and sales, revamping different regions and kind of modernizing our approach. Because in our industry, it's become super competitive. So there was a time when it was data warehousing, then it was CRM, then it was BI. Well, field service is that new highly competitive area. All the big software companies are in service right now. A lot of emerging technologies being deployed here. And I think as a traditionally engineering or product-oriented company, we had to kind of rethink sales and marketing.
Yep.
We're finally at the point where that's making an impact.
Are you, when you look at churn, just annual revenue churn on a gross basis, what are you at today?
When you be saying churn, do you mean loss of existing customers?
Not even if it's a downgrade, you may keep the customer, but they might downgrade. So revenue churn, gross.
It's very rare for us to lose customers. I mean,
not losing customer. There's that would be customer churn. I'm talking revenue churn. So that would include downgrades, even if you keep the customer.
No, it's very rare. It's going to happen, but only if they are transitioning off of our platform for some reason. And we only lose. I mean, I've been here 3.5 years. I can not count the customers on one hand that we've lost.
What about downgrades though? You keep using the word lost customers. That's customer churn. Do people ever downgrade for any reason, but still keep paying you?
The only time they're going to downgrade is if they know they're coming off our platform at some point in the future.
I see.
They're in that final stages, so they're lowering the number of users, and that is the way they would exit a platform like ours.
Yep.
But it's very rare.
Yep. Yeah, no, that makes sense. And then what about expansion? Do you know that an account in year 1 is going to be worth X amount of money and you're going to expand them to X amount in year 2? So what is that expansion you plan on typically?
Well, probably the first 6 to 9 months, it's an implementation project. So it's mostly professional services. The new buyer behavior is to go in with a very low number of SaaS users initially. So they might only buy 50 users for the launch project for 6 to 9 months. So your SaaS revenue is very, very low. That has a big impact on companies like ours. Because the buying behavior is so much different, a big impact on your cash flow. And then once they go live, they're going to jump up to that couple thousand of users. So then you get the license purchase or the jump up in subscription services and the drop off in professional services.
Yep.
So your revenue is going to go from 50 users up to, probably somewhere in the, you're going to at least go to 200, 300, 400, depending on how they roll out.
So you're like 100% year-over-year growth basically per account?
Yeah. Well, in the beginning, because of the SaaS behavior, first 2 years, you're going to probably go something very, very large like that.
Yep.
Then they're going to slow down. They're going to go into an expansion phase, which is driving services revenue, because we're the change agent at that point. Our consultants are senior consultants. We're helping them understand how they digitize and do all those cool things and put in place emerging technology. And then the user growth will be relatively low, but you got services work, then they'll do an upgrade probably in year 3.
Yep. Interesting. Okay, very good. And then team size today, how many folks are you at?
We're at about 200 globally. 200.
Okay, and across how many headquarters would you say?
We got 4 major regions, so Tokyo, Sydney, Philadelphia is our global headquarters, and then London. We have development centers in Irvine, California, and Israel.
That's great. Very good. All right. And then last question here. Do you guys measure kind of dollar-based CAC, how much you have to spend to get a new dollar of ARR?
I'm sure we do, but it's not a metric that we live with and use. So it's not something that we would really manage with.
Yeah. Very good. All right, David, let's wrap up with the famous five. Number one, what's your favorite business book?
Well, being the author of a couple business books, I'd hope I would say mine. So the
Name
last
one
book,
of yours.
Big Social Mobile, is the last one that came out, and it's been pretty well received.
Who'd you use to publish it, or did you self-publish?
No, that's Paul Grave Macmillan.
Okay, Paul. And can I ask how it did? How many copies did you sell?
It did pretty well. Yeah, we're 25,000 amongst specialists.
And what a lot of SaaS CEOs are thinking about writing books, which is why I'm diving here for a second. How'd you drive those sales?
Mostly through media, just events, speaking, writing, getting out there, getting out and about. You still have to do that. Even with a publisher as great as Paul Grave, you still have to drive it based on appearing in the media.
Yeah. So this was like TV kind of appearances or what?
Mostly what you'll find for business theory is a lot of print and a lot of radio, not so much TV.
Print and radio. Interesting. Okay. Very good. Number three, what's your favorite online tool for building the company? Or sorry, number two, is there a CEO you're following or studying?
I study a lot of our competitive CEOs.
Name one.
Well, our big ones are, look at the transition of GE buying ServiceMax. You look at the results of IFS or Microsoft or Salesforce. Those are the folks that we battle against. So we try to keep track of what they're doing.
Would you ever, you said you're out kind of on the market right now. If someone came to you like a Silver Lake or a Vista and said, let's do a take private kind of deal here, would you do that? I mean, especially you're only doing $30 million as a public company. You could really be more advantageous being private.
Well, a lot of folks have said that.
Yeah.
There's a long history of the company being public. We would have probably, a lot of folks would say, would have been better off being private. But that's quite a big decision.
Is it something though that you guys, would consider if the right offer came along, or is that something that you've already eliminated? There's no way, you just want to raise and sell secondary shares?
Well, right now that's our immediate focus. But if somebody comes in with the right numbers.
Yeah. What are you, $5.90 a share today?
Somewhere around 590. Yeah.
Yeah. Interesting. All right, there you go. Vista, any of you guys listening, come and offer $7-8. Maybe you have a deal. We'll see. All right. A share. You wouldn't go at $7-8 a share?
Oh, come on. No.
Why not? That's above your current price. That's above what the market's valuing you by a significant amount.
Sell a company for that. In our industry, you're talking in multiples of 6 to 12 times revenue or recurrent revenue. Look at what GE just did and some of the other recent purchases in our industry.
Yeah. Look what SAP just did with SAP just did with Qualtrics, right? But that was a pure play SaaS model.
Yeah. But if you look at our closest competitors, that's what
ServiceMax is your closest?
ServiceMax probably is our one-to-one closest competitor. Yeah.
Interesting. All right. Very good. Number three, what's your favorite online tool for building the company?
Probably most of the stuff that I focus on is any of our online tools in the marketing area, understanding.
Name one though. What's your favorite?
We use Marketo or Click on the marketing side.
Good. Marketo. Number four, how many hours of sleep do you get every night?
Unbroken sleep is a very rare thing in my life. Probably sleeping 4 to 5 hours.
And what's your situation? Married, single, kids?
Yeah, married. Got married in June.
Great. Congrats. How many kids? Any kids?
No kids.
Okay.
My wife's a professional dressage rider, so we have 15 horses.
Holy mackerel. Okay. And how old are you?
I'm 50.
50. Last question. What do you wish your 20-year-old self knew?
I wish I knew that it's much more about relationships and how you build relationships than just powering through raw performance and driving good numbers.
Guys, relationships matter. Coming from David, joined Astea back in about 3-4 years ago. The company was founded back in 1980. Today doing about $27-28 million in terms of run rate, growing 12-ish% year over year. They are publicly traded, so this is all out there. You can go look it up. They are kind of self-capitalized. They are profitable today. A team of 200 across their major locations: Tokyo, Sydney, Philadelphia, London. Call it 100% year over year growth on customer accounts from year one to year two, and then obviously it goes down to call it 20-30% year over year ongoing after that, as they have their upsell model dialed in. Customers staying with them in terms of lifetime value for over 10 years. David, thanks for taking us to the top.
It's great to be with you. Thank you.